This week on Bullshift, the podcast, we're speaking with Benj Gallander from the Contra the Herd newsletter. We're going to challenge the way you think about conventional stock picking. Benj has a unique approach, and he's going to make you think about stock picking in ways that you might not have thought of. Welcome to Bullshift, the podcast. This is the podcast that talks about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the author of the book Bullshift and the host of the podcast. My guest this week is Benj Gallander. Benj started investing when he was a teenager, and he's the co-editor of the Contra the Herd newsletter. He's been a regular guest on BNN. He writes the Contra Guys column for the Globe and Mail with Benj Stadelman, and he has written 3 bestsellers. Benj, welcome.
A pleasure to be here. Thank you, sir, for inviting me.
One of the things that is talked about all the time in finance that I don't think I've ever discussed with any of my guests up until now is the differentiation between the two primary competing camps, which is the active camp, stock picking, which is the camp that you're in, and the more passive or indexing camp, which I fall into. So I'll leave it open-ended and ask you to describe what stock picking is in your words and what it is.
Well, we are anything but active at Contra the Herd. In a normal year, I might buy from 4 to 8 companies, and that's it. We do not buy a lot of companies. The more companies that you buy, I think overall, on average, the worse that you're likely to do. Mm-hmm. So we're exceedingly selective in terms of what we buy. We do almost all of our buying in December, some in November, because we're buying during tax loss selling season. So that's when a lot of people are dumping their stocks, the prices go down, and there I am, Mr. Value, trying to get a better deal. But I would say I am pretty much the antithesis of being active. I'm not active, plain and simple. So the portfolio does not turn over very much. I would say the average hold time, I call it about 4 years. So right. Just slow.
It's interesting because there are different ways of approaching active and passive. I have some friends who will say that even if you decide how to allocate your ETF, your index portfolios, that's an active bet. That's an active decision. So on that level, everything is active. And then, of course, you would say, well, I pick securities, but I don't do it actively. I do it very almost slothfully, very, very methodically, relatively rarely. And so you wouldn't portray yourself as being active. And it's interesting that people use the terminology, and a lot of people listening don't stop to contemplate those sorts of nuances.
Well, once I find a stock that I'm interested in, and what I'll do is every 3-4 months, I'll go over all the listings on TSX and in the States. So I find a stock that's trading towards the bottom end of the 52-week range. Then I'll go back 10 years and see where it is relative to that. I don't buy anything that hasn't been around for at least 10 years. So that eliminates a tremendous number of the stocks. But I have no desire to be active. Right. There's no reason to be active. There's a lot of stocks people can buy, but we're very selective at Contra the Herd. And I think that's, part of the reason for the success, that the 10-year annualized return was 19.1%. Now, unfortunately, I don't get them all right.
Right.
But since we're looking generally at 100% plus returns, nothing pie in the sky there, John, as I think you know. I'm only looking at an initial sell target of where the stock has been before, often 300-400% on the upside. So I'm hoping to retrace footsteps as the stock regains its form, or sometimes you can buy into markets that have done really poorly. The stocks often then do poorly. So it's kind of a double whammy against the corporation. And there I am with my baseball glove on, ready to make a nice catch.
If you were to think of this in terms of the Morningstar style grid. I don't know if you're familiar with it. It looks like a tic-tac-toe board with 9 squares, 3 by 3 grid. And you've got small cap, mid cap, large cap, and value blend growth. Uh, you've already said, you've told me a number of times that you're a value investor. I know you're a fan of Warren Buffett, but I believe it's also fair to say, and correct me if I'm wrong, that you're more of a small cap manager, and the stocks that you pick oftentimes are trading on the venture exchange and not on the TSX. Is that fair?
No, I
Okay.
rarely buy on the venture. I
Okay.
mean, bought companies like Bank of America. I don't consider it small. Bought Hobart, which was the largest kitchen company in the States. Bought BlackBerry, which is a lot smaller than it was. But
Right.
we do buy some small companies, but they have to have a certain volume in terms of trade
Mhm.
because our subscribers, we want them to have a chance to get in without hopefully changing the stock price too much. So we're buying all over the map. A lot of times, though, we're buying companies that used to have a tremendous market cap, and now because they're beaten down, have far less. But
Mhm.
we've bought in many, many companies that are considered to be majors in their field. And we
Right.
bought some. We bought some that are somewhat off the grid that people don't know a lot about, and we do a lot of research to find those companies. And we have a lot of latitude in terms of what we buy, but it's rare we're buying anything that's really small with limited
Okay.
volume.
Good. Thank you for clarifying. Great. One of the phrases that we hear oftentimes in the finance industry is the notion that we're in or heading into a stock picker's market. And I have personally been critical of that phrase because it's nebulous and lacks a real clear definition. And I've checked like a half dozen economics and finance textbooks, and I can't find it in any of the textbooks. It just seems to be whatever it is that people want it to be. What are your thoughts on the phrase stock pickers market, and what comments would you have?
Well, we're stock pickers. Again, we're very selective stock pickers. Some people probably say you can be a stock picker's market in any market. I would disagree. Uh, we will buy far less when the market's going gangbusters. So right now, there's very little that interests us. Um, but a stock picker's market, if the stock market is badly beaten up, that to me is the best time to be buying. So when that happens, we're looking at buying into beaten down stocks in
Mhm.
beaten down markets, which kind of gives us a better chance of having a more upside.
Okay, so if
So,
I don't want to put words in your mouth, but I think I heard you say that for you, a definition of a stock picker's market would be when stocks have been beaten up. Is that a fair definition? Or if you were to
well,
define, if
sure.
someone asked you to write a dictionary definition for stock picker's market, what would you write?
That's a great question. In my almost 50 years of investing, nobody's asked me that. Um, I would look at it in terms of gradients. It's more of a stock picker's market when there's more good companies out there that you can buy, more companies that you think can have a favorable return. In terms of what we do, that's when the markets, as I said, are out of favor. When markets are going really well, like right now, when markets are, at record levels, to me, that's not a stock picker's market. Someone can pick certain
Mhm.
stocks and hopefully do very well on them. But it's not the ideal time to do it. But you'll find many of the companies out there, they like to advise people to buy when things are really hot. And a lot of people like to buy companies that are really hot. In some ways, it can be part of the greater fool syndrome,
Right.
but often you can play into momentum and hope that by buying near a peak, the company will go up that much further. No, and
So
this is
this is my point. So what I'm getting at is there are some people when they're talking about a stock picker's market will use almost the exact opposite definition that I heard you give. They'll say we want a market when stocks are going up because you're going to make money if you pick stocks. And so a stock picker's market is a market that is unambiguously rising. And I guess the point that I'm making is that there's no dictionary definition for the term. And so you could be right in the way you mean it, and you can defend it that way because that's the way you define it and explain it. And other people will use almost the polar opposite definition. And that's a definition that's defensible as well. But there's no consensus as to what actually constitutes the stock picker's market. That's my concern.
Well, whether you have consensus or not, I don't know that that is exceedingly important.
Right.
The thing is, what do you do out there to make money? And that's the key. And you and I have been doing this for a long time. And when markets are going gangbusters, often that's an indication that they're going to fall. I mean, I remember way back in '89, the technology sector was going great. And we wrote, this makes no sense. And we compared more envelopes, boring stuff out of favor with one of the high tech companies that was doing just great. But a lot of people, they really don't want to miss out on stocks that are going really, really well. I'm the opposite. I'm the contrarian. I'm looking at buying into positions that are generally, when I buy them, not exciting, but have the potential to regain excitement and to make a lot of money.
You're a fan of Warren Buffett,
Hmm.
and you and Mr. Buffett are what I would certainly, everyone knows that he's a value investor. And I think as a contrarian is, to my mind, another way of saying value investor. I don't know if you would, again, describe yourself as being contrarian as being in a meaningful way different from being a value investor. How much of your performance and maybe how much of Mr. Buffett's performance would you say is just capturing the value premium? Because historically, value stocks have outperformed a broad benchmark simply because of getting a chance to buy when they're out of favor, and then reverting back to the mean.
Well, I have tremendous respect for Warren, tremendous respect for his deceased partner, Charlie. I actually went out to the Berkshire meeting in Nebraska twice. And a year ago when I went, I took my two lads. And what a fabulous place to go. For anybody who has a chance to go, you should go soon. And one of the reasons I went last year was I thought it was possible that Charlie and Warren would not be around for that much longer. And as has happened, Charlie wasn't. Um, in terms of what is value, that's the key. And I'm looking at all kinds of financial ratios, and that's very, very important. I'm very, very debt averse. I found in my earlier years of investing, some of the companies I would invest in would have blowouts. And a primary reason that they would have blowouts is because of debt. If you have a company with no debt, it's hard for them to have major problems. It can happen. I had one company I bought into had zero debt and it still went bankrupt. It was kind of a bizarre situation, but that's one in almost 50 years of investing. So I look carefully at the balance sheet. I like to see that debt is stabilized or is going down or there is none there. And sometimes you can find these amazing companies that are overlooked. And that's what I want. And, thinking about Warren and thinking about Charlie, I mean, they've stuck to their knitting in a lot of ways. Certainly, they have tweaked their system over the years. And I think Warren would say Charlie was a reason for that. I mean, I work very closely with Ben Stadelman, who I met at University of Western Ontario 50 years ago. Hard to believe, I know, looking at me. And then Phil McKellar, who's managing the portfolio now with some input from us. He's been with us for about a dozen years. He's a very, very smart investor. So it's very, very important that you have a system, that you don't blow with the breezes. If you do that, there's a better chance you'll get blown out. So a key thing in one of my best-selling books, I have a page, and the whole page says, without discipline, you have no method.
Right.
So being disciplined is absolutely critical. And I love I invest for myself. People who might want to do it, it's not brain surgery in a lot of ways. Of course, you have to do a lot of reading, you have to understand things, but you can go through, mutual funds and ETFs, etc., and you'll pay, 2% or 1% or half percent, whatever. Whereas if you buy into 10 stocks, you can pay $10 each or less. So that's $100, say, and then maybe you'll hold them for a number of years. There's no additional costs.
Right.
So to me, that's a smart way of doing it. So, my little bit of advice here for people is read widely, talk stocks over with people, get some good advice at the same time, but don't be afraid of investing in stock. And if you are afraid and want someone else to do it for you, make sure you look carefully at the expenses that they're
Right.
going to generate.
Good. So that's a really good tie-in, both the expense comment and the comment about going to Omaha. I, in 2017, made a pilgrimage to Malvern, Pennsylvania, to meet one of my heroes, John Bogle.
Mhm.
And it was the same sort of thing. I wanted to meet him while he was still around, and as fate would have it, he passed away a year or two later. So I just managed to get in under the wire. One of the things that Mr. Buffett has said is that when he's no longer around, he's told his family members just to take their money and to give it to the Bogle people at Vanguard and to just buy the index, which I found, I suppose, intriguing, interesting. But I think maybe Mr. Buffett and Mr. Munger don't have as much faith in other people who might be doing what they do. They might not have the discipline and the methodology that they had. What are your thoughts about Buffett's admonition to his family to take whatever money they might inherit when he's no longer around and just put it into a Vanguard S&P index fund?
Well, I think the first thing is an assumption that Warren will still have some money there when he dies.
Yeah. Right.
Um, I think, as I said, it's not brain surgery investing, but for those who want to put their money with someone else, Bogle's they've had a great track record. That could be a good place to go. So it's not bad advice. And for a lot of people, they're working full-time jobs. They've got families they want to be with. They've got friends they want to be with. In my case, I like playing my sports. Whatever it is, they might not want to spend their time on the stock market, plain and simple. And I get that. But if you don't want to do it and spend the time, look out there at who has a good track record, but don't get caught up in the companies that advertise their track records the most are the ones that have done really well in the past number of years. And there's something, as you know, of course, regression to the mean. So I don't think you want to invest in things that have done really, really well in, say, the past 3 to 5 years. Often the best thing to do is be a contrarian and say, what hasn't done well? And I'm not saying invest in things with high expense ratios, but take a look at what hasn't done so well, because it's a better chance that they'll do well going forward. But for someone who wants to imitate somebody's methodology and not pay the fees, what they can do is look at certain mutual funds that might make sense, or Bogle or whoever, and say, what are their top holdings? Maybe then I'll just play some of their top holdings if they make sense.
Buy some Gillette, buy some Coca-Cola.
Yeah. So rather than pay the expense ratio, okay, you buy your Coca-Cola. It's not my kind of a stock, but I certainly do drink their products sometimes, not as much as Warren does. But that could be another way of doing it. Take a look what they own and say, okay, this makes sense to me, and then do it on your own. So,
what are your views on the concept of market efficiency? I again have spoken to a few people about this, and I told you I was going to ask you about this because I actively want your viewpoint. My view is that markets are mostly efficient, highly efficient, but not perfectly efficient. But I'm interested in your take because I know yours is different.
Well, two things. One is I couldn't have had the returns that I've had if markets were perfectly efficient. It wouldn't have happened. So I'm going to take you back to my MBA days at Dalhousie University. And I had a professor there, Alan Rugman, who I really liked. Nice guy. He actually chose me to do bursary work under him. He didn't like my bursary work because it didn't support his theories. It happens. But a very, very nice man. And he was big on perfectly efficient markets. And I had a debate with him in class, a rather strong debate. I wasn't volatile then in that particular debate, but I argued strongly against him. And he disagreed. And at the same time I did it, I was a little leery. He might decide to knock me down a few pegs on my marks. And when I did it, if you got 2 C's, you're out of the program. Fortunately, I never did. Anyhow, he was a big proponent of it. And there was a guy in the group, MBA, who had worked in the stock market for a number of years. Super cool dude, too. I wish I was as cool as him, John Motherwell. And he said to me after I debated with Rugman, he said, "Why do you bother? Why do you bother to have that debate?" And at that point in time, it was something that Benj Gallander, as I was known, had to do. It's who I was. I would still discuss it and disagree with perfectly efficient markets. There's some efficiency, but I don't know anything that's really perfect. So it just makes zero sense to me. But a lot of people, they'll hang their hat on it and say, this is the way it is. My hat, I'll just leave on my head.
Okay. I wanted to give you a chance to put that onto the record. Let's conclude with the way we always conclude, which is that's bullshit and shift happens. If it was up to Benj Gallander and there was one thing that you could point to as something that really annoys you about the financial services industry, what would it be?
Well, the financial service industry is about money to a large degree. And I wrote at the end of one of my best-selling books, The Uncommon Investor, money often costs too much. And I think that it does. So there's a lot of tremendous people in the industry. There's a lot of people who are looking to line their pockets, and they will do it at the expense of their clients. Now, how do you change that? Good luck.
Okay, so then that shift happens. If it's up to you, if money costs too much, I think I heard maybe that means fees are too high, or does that mean access to credit is too expensive? I'm not exactly sure what money costs too much is, but define it as you wish. But how would you solve the problem now that you've identified it?
Well, I think money often costs too much. People dedicate too much of their lives to it. But money is necessary to have a house or pay for an apartment or food, that kind of thing. The industry is very well entrenched, and it would be very, very difficult to change. Perhaps in the courses people have to take to become brokers, etc., they should have to take something about treating people well. They should have to take something about, what should we be doing to make sure that our clients can do the best that they can. There has to be reality to it too. These people want to make a living, but you want to get some of the greed out of the system. So maybe a course would help. Maybe teaching people how to deal with other people. Maybe I'm just dealing with pie in the sky here, but yeah, there's certain things that have to change. And I've seen a lot of that greed. I used to go down in my early days to Yorkton Securities, which was a bit of a funny house, but a very close friend of mine was a broker there. And I would just watch the people at work. And I got a real sense of the greed from what the people were doing there.
Good. Okay. Thanks for that. I appreciate that, Benj. It's been a pleasure. Always great speaking with you. And I want to wish you all the best in your future endeavors.
And I wish the same to you, and look forward to the next time I see you.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.